Okay, we've just got a caller on the line at the moment, Sam from Sydney. Sam, what's your question for Robert and Brad?
Yeah, hi, good evening, and thank you for taking my call. I really enjoyed watching the show. My question is about investment property. I'm new to the property market, and I've got two options at the moment I'm considering, which is the first one is, at the moment now I'm saving for my for a deposit for my house. And the first one, I'm thinking whether to save money for my first home, and then later on, probably a couple of years later, I can use the asset for my first home, for property investment first home, or whether should I save that money and buy my first home and live in, use it for a first investment property.
Oh, so yeah, that's an age-old question, isn't it? Whether to buy to live in?
Yeah.
Sorry, Sam, what was that?
Just want to know your opinion about whether to use the first home for an investment deposit for an investment property, or the first for my first home, instead of paying rent. It's going to go down the drain. Yeah.
It's already been reduced a bit, hasn't it? The boost to the first time owners grant.
Sam, with the current window of opportunity that's out there for you at the moment, from a financial point of view, you're probably, for the short term anyway, best off looking at acquiring the property as an owner-occupied residence. Now, there's a twofold approach to this. One is that you'd get there's still some pretty lucrative cash incentives for you to do that, such as grants from the government. But another one is also the discount in stamp duty. So theoretically, we're talking on average about $20,000 by buying an owner-occupied property in the current market, as compared to you nominating that as an investment property. So if in today's market you can buy that as an unoccupied property, financially that'd probably be your best situation. If going forward you wanted to move out of that property, you could still probably move out of that property and rent it out and still be eligible for all your tax deductions once you physically moved out of it. So do speak to your accountant also in regards to that, though. But financially, with the current windows that are open till the end of the year, your probably best option would be buying it as an occupied property.
What's your question for Brad and Robert tonight?
Thank you, panel. I have the same situation as Sam. I'm a first homeowner, or first home buyer rather, and I have an opportunity in Gladstone to buy a duplex. So I could own one, basically as a first homeowner, and the second one as an investor. Is that allowed?
Yep. Al, are they under one title or are they under two titles?
Two titles.
Okay. Because they're under two titles, yes, you can buy for example, the first one as an unoccupied property, and then have the second one as an investment property. So yes, you can do that.
There you go. Good news for Al then.
Robert, what do you think in terms of what people want today? I'm finding that young people tend to want more for their first home.
We're noticing it today. We get the pre-approval, for example, at say 90%, right? So they've got a relatively small deposit. I mean, 12 months ago we were getting home loan approvals at 100%. They came back to 97%. They came back to 95%. And today, from a lender's point of view, they require that 10% equity component. As a first home buyer, 5% or thereabouts comes from the first home buyer's grant, so today they need to find about 5%. What's very interesting is that once we're doing that, they're already doing their sums, saying, okay, well, I want the plasma TV, I want the renovated kitchen, I want to do the bathroom. They want to do all this at acquisition stage. So, and then in addition to that, they're already saying, okay, well, I can go out there and get my interest-free, all my brand new white good appliances today.
Absolutely.
So when I move in there, I'm all set. Yet probably even, I've got 3 young kids, but even my generation and people like that, we didn't get everything that was brand new when we bought our first home, 20 years ago. We got the old home, then going forward we'd renovate part of the bathroom, then we'd say, renovate the kitchen or whatever. They just want it all today.
So, Robert, just talking about those changes in prices, I know that everybody feels that the reason why the lower end of the market is going up is because of the first homeowners grant. How much impact do you really think there is from that homeowners grant on that market? Or is it just the fact that the interest rates are low and investors are attracted into a market like that and they traditionally will buy lower end?
I think it's probably a combination of both. The first home buyers stimulus with the grant extension, I think it has had some impact on that, but I think the major impact was the rates. When it gets to an equilibrium where it's cost effective for them to buy instead of rent, and I believe that once the government slows down, which they will be doing very soon, the amount of income or the amount of cash that will be actually allocated towards first home buyers, the supply and demand factor should start coming back off a little bit, and I think that's when you'll see more of the investors start coming back in. Because at the moment, the investors are actually competing with people that are looking at it from an emotional point of view, that's going to be my home, so if I need to pay $5,000, $10,000 a bit more, I'll actually do it because I've got a place to stay, and going forward I'm going to raise a family here. The investors are pretty clinical. They're saying X is my purchase price, Y is my return on investment, it stacks up with this figure, at that next figure I'm not going ahead, and they move on. When the first home buyers, or the volume of first home buyers isn't quite the same as what it is or has been at the moment, I think the supply will start becoming more available, and that's when the investors will start coming in and start reaping some of those rewards.
Okay, great. So, and she says, my daughter has recently opened a first home savers account. The product doesn't seem to be well publicised, even though she gets a 17% bonus each year from the government, and Members Equity Bank pay her 6% interest. What does the panel think of this form of savings? Let's start with you, Robert.
Yeah, it hasn't been taken up much at all, actually, as a perspective in regards to what they were thinking that it would the take-up rate would be like. There are some restrictions around there, and it needs to be there for a certain period of time, and certain deposits need to get made. Generally speaking, any bonus that anyone's prepared to give them as a first home buyer, I'd say yes, take it up if you can, of course. But also the government wanted first home buyers to come into the market. This was one of the incentives that they sort of came out there with. It is a good thing if they can take it up. Not very well publicised. It got some publicity when it was originally launched, but since then the focus has been more on the grant and the amount of the grant. Will it hang around? How much for? And then is it going to be more focused towards existing property or new? So the focus hasn't really been that much on that particular product.
I actually did a series of ads for the tax office on the first home saver account when it first came out, and just to answer your question, if the person puts the maximum amount that they can into it, and then they also get the co-contribution from the government, they can boost their savings over a 5-year period by about $18,000. And let's face it, $18,000 is $18,000 if you can get that. As we were
saying, Margaret, earlier, the young people of this generation don't want to wait around for 5 years. So if the predictions of what people like Rismark tell us capital growth might be for the first home buyers market, if they're going to wait 5 years, I think that $18,000 might get eaten up in potential capital growth quicker than it possibly could.
So
one side, if they're going to be waiting 18 years to save or get a benefit of $18,000.
Well, 5 years, yeah.
Sorry, my apology, 5 years.